Well, a few days ago, we were looking at a possibility, low probability, but a possibility of some interference with the Fed's independence. The market reacted to that. I think it's another example of how some of these policy changes come up against the reality of the market and economic impact that they have, and a few days later you see them being moderated a little bit. We've seen that in a whole host of areas now. We've seen it in tariff policy, we've seen it in sectoral tariffs, now we've seen it in some of this. But it's adding to the general volatility that we're seeing at the moment in markets. We're in a kind of new world, a more volatile world, higher volatility in equities and fixed income, which creates some quite interesting implications for portfolios.
But the uncertainty doesn't go away, nor does the pressure on the Federal Reserve, because the president still wants interest rates to be cut. So, the Trump administration has successfully moved the argument, hasn't it?
Well, I don't know, but the Fed will stick to its knitting, I think. Powell's been very clear about that. And the shock that they're facing here is a challenging one for the Fed, because it is going to slow growth, but it's also going to raise inflation. And there's obviously the direct impact of higher prices from tariffs, but there's also a couple of indirect impacts that could take longer to work through and persist for longer. So one is that supply chains could be disrupted as a result of some of the very high China tariffs we're seeing at the moment. And the other is that if the US consumer, and there are some initial signs of this, actually starts to shift its spending patterns towards more domestically produced things and services, a bit like the opposite of what we did in the pandemic, actually you could see more domestic inflationary pressure then as well. All of that puts the Fed in a very difficult position in terms of balancing higher inflation in the short term and weaker growth at the same time, and means that rate cuts probably not going to be sudden and sharp. They may be limited and more gradual.
So given all of that, Alex, how do you position, how do you trade in this more volatile world?
Well, I think there's a couple of angles to it. The first is that we need to diversify for stagflation. So for weaker growth and higher inflation, which means long bonds, particularly the US Treasury, not such an attractive diversifier in this environment. That said, European bonds, gilts, have performed like a more attractive diversifier. But I think more than that, portfolios need in them now something that just takes down broad market exposure, broad market beta, things like liquid alternatives, things that generate returns from long-short calls relative to the broad market, because you haven't any longer, when it comes to US assets, got this nice negative correlation between stocks and bonds.
In terms of the European gains, how much does Europe benefit? We've seen major outflows out of the US into European stocks and bonds. Janet Henderson, just the latest, thinking and looking at potentially cutting 10% of their US exposure. How much more does Europe benefit from that and the UK?
Yeah, I mean, Europe's been the major beneficiary of that reallocation. You see that in the exchange rates, particularly exchange rates relative to yields, which that correlation is broken, which is all suggestive of particularly European investors demanding now a higher risk premium on US assets. And we are hearing from some investors, you gave one example there, of wanting to reallocate portfolios away from, if you like, a broad market cap weighted index to a more building block weighted approach, if you like. Decide your own index, whether that's weighted according to GDP or some other measure.
You talked about effectively bond markets and markets more broadly reining in the Trump administration. Do you think then that we have seen peak volatility, or is there much more of that to come?
I don't know whether we've seen peak volatility, but I think for sure we're in an environment where volatility stays more elevated than it has done before. I think that's one feature of this environment, and it calls for more agility in asset allocation as well. Just sticking to a broad index, set and forget, hasn't tended to work too well in these more volatile environments. Now, the tools are there. We've seen record trading volumes in ETFs. So people are reallocating pretty quickly through this volatility, and they're using the tools to do it. And actually, as a result of this, there are opportunities emerging in things like European banks, in healthcare, in AI adoption, for example. We shouldn't let those opportunities go passing just because the broad market is adjusting.